Welcome to Turning Hard Times into Good Times. I am your host, Jay Taylor, and speaking to you here on February 14th, 2017. Happy Valentine's Day to everyone out there. I'd like to remind you each week that I am the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And you can subscribe to that letter by going to miningstocks.com, or you can call our office here in New York during regular work hours, 718-457-1426, 718-457-1426. Also like to encourage you to consider subscribing to Chen Lin's letter, What is Chen Buying, What is Chen Selling? To do that, you can go to chenpicks.com, chenpicks.com. I want to thank each of you for listening to this show, making it one of the more popular shows on the Voice America Business Channel. And keep your questions, comments, criticisms, and praises coming along to questionsfortaylor@gmail.com. Also want to thank our sponsors for making this show economically viable. Today's show is sponsored by Dynacert, Golden Predator, Chilean Metals, Arvista, Novo Resources, Uranium Energy Corp., and Aran Resources. I've titled today's show, Doug Casey Compares the 1930s and Today. And Doug will be our main guest at half past the hour. Peter Talman will be with me right after the first commercial break. And Michael Oliver is here with me just to comment on the markets momentarily. As Doug points out in an article he wrote this past week, generals commonly fight the last war. And when times change, very often those strategies don't work very well. And he draws the parallels with the generals at the Fed and the Treasury are also trying to fight the last war. And, frankly, they weren't very effective the last time in the 1930s. But they seem to be applying the same medicine that didn't work well then. They're trying to make it work this time by doing even more of something that didn't work well the first time. Well, Doug is going to talk to us about what this impending depression is likely to look like. Maybe a lot of people think that it's just silly to talk about depression because, after all, the gods at the Fed have all this money-creating ability, and there shouldn't be any reason to even worry too much because, we've placed our fate in their hands, and haven't they done a marvelous job? Well, that's, of course, questionable. The propaganda would suggest they have, that you hear on the mainstream media all the time. But we'll talk to Doug about that and many more things. But primarily we want to get his take on how we should prepare going forward for the mess that lies ahead of us down the road, and frankly not so far down the road. If you're living in middle America, it's already started to a great extent. As I mentioned, we'll be talking to Peter Talman. His company, Klondike Gold Corp, is a very interesting company. It's one that I own. It's one that's recommended in my newsletter. And Peter will have some interesting things to tell us about that. It's really comparable, as you'll learn, to the 1849 gold discovery in California, only the Klondike was far enough north that a lot of people, it was just harder to get to. And so it has never been explored to the extent that the gold fields in California had been explored in the past. But we're very fortunate to have Michael Oliver with us right this second to get his take on the markets. Thanks for joining me again, Michael.
Good to be here, Jay. Thank you.
Always good to have you. And I would just note to my listeners, it's olivermsa.com, olivermsa.com. And I understand, Michael, you have a new website, and you've revised your subscription structure to some extent anyway. But anyway, people might want to go there and check it out in any event. But I think it's a very good-looking site, and probably more reason than ever to go there. Michael, last Saturday you put out some charts that looked, I thought, very positive for gold. Specifically, I noted your weekly momentum charts show a breakout above a weekly momentum downtrend from January 2016, almost a year. We had a good bull market. We had a nice uptick, a good market up last year in 2016 until the last part of the year. But it looks like we're breaking out again, according to that chart. The momentum chart especially looks very positive. Do I have that right?
Yes, you got it right. The gold market looks like it has put its elbow up over, I'm talking intermediate trend right now. Mm-hmm. Long-term trend, as far as we're concerned, turned positive February of last year, and nothing has changed despite the September to December sell-off last year. While it was sharp, it did not alter our assessment of the long-term momentum trend. and it held precisely where it needed to, within $4, a number we did not want to see, and we did not see it. And since then, its market's rallied well over $100, a lot more than that, in fact. And it may nest around here for a while, which is what it's doing. But on an intermediate basis, not looking at the very long term, that downtrend that persisted really showed itself late last year. When you measure it in momentum terms, a breakout has occurred back to the upside, indicating, okay, we've broken the backbone of that period of sell-off. Now, the price chart may not reveal it, but momentum does. So I'm pretty comfortable with the notion that gold is now safe. It may congest. You could pull back $20, something like that. It's irrelevant on that issue. But I think that was the low down there just above 1120. Right now we're in the 1220s, et cetera. I'm also watching other things that are behaving in a similar manner, in particular the yen, also watching the euro. But I think the stock market is probably capturing all the headlines, we know that, and the attention. So some of these other markets, which presumably should be collapsing in the face of a strong stock market, are not. They gained a lot of ground, and they're holding it. And they're more or less sitting there in the bleachers watching the stock market spike itself. And I put out a report. In fact, I don't know if this ever happens to you, Jay, but sometimes I dream markets in my sleep. And I had this vision of the Chrysler Building and the chart of the S&P going back to 2009. And I did a report today sent out this morning called Slip, Stumble, Fall. And that means three different levels that I'm trying to identify. I think we're if you look at the Chrysler Building, there's a spike on top of it. I think that's where this market is right now. And what we're trying to do with MSA, in fact, if people go to the site, that you can request a sample copy and that'll be sent to you, that particular report. But is to identify first a near-term downturn that looks credible, two, an intermediate downturn that breaks something of larger consequence on momentum now, and three, a full resumption of annual and quarterly momentum downside. So like three different levels on the ladder I want to see broken. And frankly, the distance between triggering the uppermost of those negative trigger levels and the lowermost is only about 6%.
Wow.
So it's not like I got to drop 20% to prove the case.
Right.
The S&P just needs to start to slip, to stumble, and then fall. And I think that's what one should be thinking right now, is eyeing this market with a scope and trying to measure each of those downturns.
Yeah. Well, I'm looking at your report right now, and it's very interesting. You show the parallels between the Chrysler Building and the S&P 500. Again, Michael, that's very generous of you, so people can actually go to olivermsa.com and request this report, and you'll send it to them. Did I hear you right on that?
There's a sample box you can request. If you're interested in subscribing and the rates don't bother you, then we'll be happy to send sample reports, including that one, and for your consideration. And anyway.
Sure. One more question before I let you go here. You also recently put out a chart showing the relative value of silver to gold. Would you comment just briefly, take a minute, and why is that important?
Well, we all know that historically silver tends to outperform gold in bull markets. The question, therefore, is this. Silver broke out versus gold on a relative performance basis some months back, okay? But then we had the sharp sell-off late last year. The question is, during that sharp price sell-off of gold and silver, did the spread relationship between silver and gold revert the other way to where silver has done something bad to itself on a relative performance basis? And the answer is no. Yes, silver suffered more in the break, but it did not technically reverse or negate the breakout it had in performance some months prior. So that trend that favors silver, yes, it did have a bit of a correction during the late last year, disfavoring silver, but it did not alter the trend, and the new trend being favorable for silver long-term versus gold. So, in effect, the spread echoes our view that the pullback in gold, while mighty and scary to many, was largely irrelevant to the long-term picture.
And means also, I presume then, that the bull market in precious metals in general is still intact.
Intact, yes. In other words, the spread between gold and silver and gold, still favors that presumption that silver is in an outperform mode versus gold. And last year's action did not negate that. Yeah.
And we know that gold outperforms silver in a bear market generally, but in a bull market, us gold bugs are happy to see silver doing very well, because that means that we'll go along for the ride.
Correct.
Yeah.
That's the
Excellent.
way I see it. Mm-hmm.
Excellent. Well, thank you very much, Michael, for coming on and sharing your wisdom and your views of the market. Always very valuable. So we'll look to do it again next week, hopefully. So
thank you, Jay.